Hello and welcome to Sovereign Financials, financial education for everyone.
Hi guys, welcome back to Sovereign Financials. Today we're going to talk about the very large amount of corporate debt that has accumulated in the markets. This is causing the market to be very unstable, and it's actually causing bonds to start paying negative interest rates, which does not make any sense. So first we're going to talk about corporate bonds, and I want to just give a little example of how corporate bonds or how any bond really is priced. So when you buy a bond, there's two major aspects to it. There's the price of the bond. I can't write very well here. There's the price, and then there is the interest rate of the bond. And so you buy it at a certain price, and it gives you a certain interest rate, right? Let's say it's $10, a $10 bond, and it's going to pay you a 5% interest rate. Okay. Now, the market from there can go up or down. So interest rates can either go up or down. So if the interest rate starts going down on other bonds, and then let's just draw this little balance out here again, right? So oops, let me clear that. So let me just erase this here. So now let's say in the market, interest rates start to go down. So interest rates are now 2% for other bonds, right? And since the 2% is a lower interest rate than the 5%, that means the price of the bond that you had actually goes up. So you made more money. Now maybe that bond you bought is actually worth, let's say $15, right? Because, and there's some math behind this. We're not going to actually go over the exact numbers in this specific video. But if other bonds can only get 2%, that makes your 5% worth much more. So then the price of your bond actually goes up and people will pay you a higher price. So you could buy a 30-year bond, let's say for $10, it pays 5% interest rate. And if the interest rates over like the next 2 years drops to 2% and the price of your bond goes up drastically, then you can turn around and sell the bond for a pretty quick profit. And you don't have to hold it for the full 10 or 30 years, or whatever it is that you got the corporate bond for. This is going to help explain why people would buy a bond with a negative interest rate. So if I loan Bob, right, $10 and I want some percent interest, right, it's always going to be a positive number. I want, 1% interest, 2%, 3%, something. But if I would never personally make a loan to Bob and say, hey, Bob, you know what? I'm going to charge you a negative interest rate, and instead of giving me the $10 back, give me back $8, right? That is a terrible investment, right? That is a huge loss, and that makes no sense in a traditional financial market. And people used to think that the interest rates could go down to 0%, like a free loan, but they thought that it would never go to a negative interest rate because it doesn't make any sense. Like you're guaranteeing a loss, right? But now that we understand that if the interest rates go down, right? If the interest rates go down, then it makes your bond worth more. Because if people, let's say I have a $10 and let's pretend it's at 1% interest, right? Now the next bond that comes out is $10, and now they're only paying, let's just say 0% interest, right? Bam. All of a sudden, people are like, man, I'm going to buy somebody else's bond, a new bond for 0%, or I could buy this guy's bond that's paying 1%, and therefore the price of my bond went up. Well, if people are thinking like, hey, interest rates are at 0%, they're going to go negative. It's going to be negative 1% next month, and the month after that, it's probably going to be negative 2%. Now, if you think that right now, let's say right now the rate is a $10 bond, and it's a negative 1% interest rate, that's terrible. That doesn't make any sense. That's not an investment. That's a guaranteed loss, right? But if you say, hey, you know what? Next month, the interest rates are going to go down more, right? So here I am at negative 1%, and I have my $10 bond. And if I think, hey, you know what? Next month, it's going to get even worse. It's going to be negative 2%, right? That same balance. Now my bond is worth, let's pretend, $12, right? And then I can sell it and make money. So the people buying negative interest rates is a gamble that the interest rates will go even more negative and therefore I can make money. It's not meant to be like a long-term investment, right? People are trying to gamble that the interest rates are going to keep going down. This is a big problem because number one, if interest rates don't go down, let's say they just stay right where they're at, then people actually end up their $10 actually becomes $8 and they actually lost money. That's not good, right? The other thing is now on that same balance, right? If the interest rates go up, let's say interest rates return more to normal, because like right now we're at very, very low interest rates. The 10-year treasury is at 1.4, 1.5%. So if interest rates go up, let's say interest rates go up to 3%, and you had a negative 1% interest rate bond, nobody in their right mind would buy this. And then your $10 that you had now just tanks. I mean, this probably become essentially worthless, right? It'd probably go to zero. But let's pretend it doesn't go to zero. Let's say it goes down to, $2, right? You took a 80% loss. $10 down to 2. That's terrible, okay? But this is the bet people are making. People are making the bet that interest rates will continue to go more negative. All right, so now that we got that out of the way, let's talk about credit ratings real quick. And I'm not trying to get into too much detail here, but this is the Standard & Poor's credit rating. And what they do is they rank companies on how likely they are able to pay back their loan, and without going bankrupt, essentially. And there's this cutoff right here at BBB minus. Okay, so these things, anything at BBB minus and above, anything better than that is considered investment grade. Now, if you have a pension fund or a mutual fund in a lot of areas, they're not allowed to invest in anything below BBB minus, triple B negative, because that is non-investment grade. Those are called junk bonds. They're speculative investments, and a lot of times they end up losing money. But they paid really, really nice interest rates if they don't go bankrupt, which is why people would invest down here. Now, there's multiple states that have exceptions for this, and some pension funds and mutual funds are able to invest down here in this category, but a lot of time they're limited in how much they can invest down here. If you have a pension fund, you don't want to invest in the riskiest assets that are likely to go bankrupt. That's what all these mean. All these things means they're not, they're most likely to go bankrupt. You wouldn't want to put all your pension money in that or a mutual fund in that, right? So you're supposed to invest here and above. The rise in all the corporate debt. So this is from this website here, and it says the rising risk in corporate bonds. The BBB rated debt tier is increasingly populated, by people that you don't want to probably invest in right now. And then we're gonna kind of just come down here, but in 2018, they had a total loss of about 3%. Right? That's not terrible. I mean, that's not good. It's not an investment. It's a loss. It's not a gain, but it lost 3%. But there's been a massive increase in corporate bond issuance since the last recession. But bonds rated BBB, which is the lowest quality considered better than junk, we here at SF call it pre-junk, because that's essentially what it is it's not quite junk yet, but that's where it's probably headed. It has grown nonstop from 10% in the 1980s. It's just gone up by a lot, and okay, well, who has pre-junk bonds? So it's General Electric, General Motors, AT&T, I think Verizon as well, Pacific Gas and Electric, CVS, and these companies have a ton of debt. And if they end up getting downgraded, right? If they get downgraded to junk, if they go from pre-junk to junk, then companies like pension funds, yeah, my writing's terrible. All right, pension funds and mutual funds will end up having. We'll have to start selling them because they're only allowed to have a certain percentage of it, or sometimes they're not allowed to have any of it. And then if they're selling all the bonds, then the bonds become worth less and less, and people take really big losses. And this is just for normal positive interest rate, just pre-junk kind of bonds here, okay? And then if we look at this article here that's written by CNBC, there's been a surge in corporate debt with negative yields poses risk unlike anything investors have ever seen. The negative yielding, which is a negative interest rate, corporate debt recently passed the $1 trillion market value. So there is $1 trillion or over $1 trillion in loans now that have a negative interest rate, which is essentially a pure gamble on the fact that people think interest rates will become even more negative in the future. If interest rates stay the same, or if interest rates actually normalize, those become bad, either worth nothing or worth very, very minimal amount of money. And then right here, the financial system doesn't work with negative interest rates. If the economy recovers, the losses that investors would take are unlike anything we've seen in the past. And then they have this graph here, and I'm going to go ahead and zoom in on this a little bit. So this is the total negative yielding corporate bonds, right? And I think one of the big, let me give you an example, like Nestle has a negative yielding bond. It's small, it's like negative 0.15, 0.2% or something like that last I looked. I don't know exactly what the number is anymore, but it's still negative nonetheless. But if you go back to 2015, there's almost nothing. There's almost no negative yielding debt because it just doesn't make sense. And if you look here from January, July, and then all the way up to now, August 13th, the amount of negative yielding corporate debt, negative interest rates, is gone over $1 trillion. That's absurd. That's an absurd amount of money that's paying negative interest. That is not a healthy economy. The interest rate risk that these bonds carry is huge. And if the economy recovers, the losses that investor would take are unlike anything they've ever seen. Just absurd numbers, okay? Now, it's not just corporate bonds that are also negative, but there's also full-blown countries that buying their bonds are negative yields as well. So, stuff like Germany has a negative rate, Switzerland has a negative rate, Japan has negative rates, and quite a number of countries that we'll go into in a little bit. And basically, as people are saying like, hey, look, I'm okay with paying, negative 0.45%, right, which is a guaranteed loss, because I think in the next, let's say next year for pretend, I think interest rates will be negative 1%. And if it's negative, if the interest rate went down to negative 1%, then the price went up, right? So then I'll make money because the economy is even worse than it was before. That's not a healthy bet to make, but it's the bet that people are making. And so far they've been right. I hate to say it, right? Rates, let's say they were at 5% before the recession, and then it dropped down to almost zero, and then we're at like 1.45% right now, and most likely, and the Fed just cut, right, another 25 basis points, which is zero. They cut by another 0.25%, and if there's a recession, they'll probably cut another 0.5% right off the bat, maybe more. But betting the interest rates are going down and then also to negative is they're probably looking at the right kind of thing, which is unfortunate, but it's kind of the truth. So anyways, negative yielding debt hits record $14 trillion as the Fed cuts. And I want you to notice that this article was written on August 1st of 2019. I'm going to show you that the estimate of this number has already increased to 17 trillion, which is just a record jump from 14 trillion to 17 trillion in 1 month. Negative yielding debt, it's crazy. So here, this is from 2015 to 2019. This is the negative bonds, and it broke 14 trillion. If you look back here in 2015, this number was not quite zero, but it's close. And then now we're way up here at 14 trillion. And if you see there's a huge jump here, but really, I mean, like, this is like a long time frame here. This graph, if you were to look at it, if you kind of extended it out, I mean, this thing just kind of went like this, right? From almost zero to 14 trillion is a very large gap. They made this graph look nice by going by 2 trillions at a time, from 0 to 2 trillion. That's just absurd jumps. Like this thing really is just going like that. All right. And this is just not good stuff. All right. So this is what I'm talking about later on. This is written on September 1st, just 1 month later, and then negative yielding debt tops $17 trillion. A lot of it's in Japan, 7.3 trillion. You got France, you got Germany. I don't see Switzerland on here, but Italy, Spain, Netherlands, Belgium, and then let me go to this thing here, right? So this is paying to lend. The negative yield phenomenon in Europe is driving rates on U.S. Treasuries lower and keeping the U.S. dollar strong. So if you're in a country where the rates are negative, let's say negative 4%, right? You want to get your money out of there. Like, if you're not making this risky bet that interest rates keep going more negative, and you're losing 5% of your money every single year, you need to get your money out of there. And currently, the way to get your money out of there is, is going into the U.S. You can go into U.S. bonds, because the U.S. is it's small, right? It's like 1.4%, but at least you're making money instead of losing money. And all these other countries. So blue here are negative interest rates. So Switzerland is blue, 1 year, 2 year, all the way out to 10 years. All that is Switzerland's all negative interest rates. Germany's negative interest rates all the way out to 7 years. This is a little bit dated. This is a couple months old. So actually, this is like 2015. I'll show you. There's another one though from just a couple months ago that's pretty similar. Netherlands negative, Denmark negative. So if you're in these places, you want to buy U.S. Treasuries, and then therefore, as more people buy the treasuries, then the U.S. Treasury is able to lower the interest rates lower and lower, and as people have higher and higher demand for it. And then this is from David Stockman here. This is his chart of the day, I guess. This is like really weird. That's not writing where I'm. There we go. This is from June 13th. And I'm going to zoom in on a little bit of this so you guys can see this a little bit better here. So this is a little outdated too, right? But just to give you an example here, right? Switzerland, look, 1 year is negative. Oh, it's not writing where I want it to go. Sorry, guys. Let me see if I can fix this here. Nope, it's not. It's not working. But if you see here, Switzerland is at negative 0.8%, for 1 year. their 5 years is negative 0.8%, all the way out to 20 years they were negative at the time. And you see all these countries just have all these negative interest rates all over the place. And the U.S. right now is really the only place that still has positive, or not really the only one, but one of the few that still has positive interest rates. All of Europe is essentially negative after the European Central Bank did a bunch of quantitative easing and decided to buy a bunch of bonds. So even places that are super risky right now, in our opinion, like Spain and Italy, have negative rates, which makes no sense because it's a super risky bet to play. So as more people end up buying U.S. Treasuries, the Treasury yields go down, and eventually they'll probably go negative here as well. This is some really risky stuff. I think that in 2008, 2009, the biggest problem that caused the Great Recession or the Great Financial Crisis was the amount of mortgage debt that was, basically mortgage debt was irresponsibly taken up by people that couldn't pay for those loans. But then it's also part of Wall Street's problem for securitizing those loans and sending them out. But basically, mortgage debt was the big problem of the 08, 09 financial crisis. I think this next financial crisis could very well be the amount of negative yielding debt, which is both corporate and government negative yielding debt. And like I said, one of those companies that we were talking about earlier, like I'm just going to come back over here, you look at GE or General Motors, AT&T, Pacific Gas and Electric, CVS. I think Verizon fits in this group. I'm not 100%. But if one of those, so those right now are pre-junk, right? So pre-junk, like what's the catalyst? What could cause all this thing just to come crashing down? Those are pre-junk. Now, all these countries, especially GE, right? Like these are really close to default. And once they're default, if they default, they get rated down to junk. And if that happens, pension funds and mutual funds they will most likely, I'm not going to say guaranteed on anything, but most of them will end up selling their bonds. And they may not just sell GE. They might be like, hey, you know what? Maybe General Motors is next, or maybe AT&T is next, or whatever, or CVS is next. And they might sell all these. And as there might be a rush to the exit, right? If there's somebody starts making really big sells and selling all their bonds that are pre-junk because they're afraid they're going to become junk, that can create the bond market to crash. And if the bond market crashes, then we have huge problems, right? Because pensions have huge investments in the bond market. Mutual funds have huge investments in the bond market. People's 401ks have huge investments in the bond market. IRAs. You're just talking about just a massive, massive problem. And I think that the total amount of debt and even the negative yielding debt, that could very well be the catalyst for our next recession. All right, guys, if you're interested in the Sovereign Financial newsletter, you can go to sovereignfinancials.com/subscribe. We actually just released, I think it was a 9-page report on corporate debt, negative interest rates, and the U.S. yield curve inversion that goes into much more detail on all this, and also some ways of how to protect yourself. I think next video will probably end up being on the U.S. Treasury yield curve inversion and how that also signals to us that a recession is likely coming up. But this is definitely the time to be prepared. You don't want to get caught with your pants down and just have like, oh, I have my 401k and my pension and everything's fine and dandy. Like you need to make some active choices here on how to protect yourself if there is another recession, which there should be recession, like every 7 to 10 years. And right now, I think in the second longest stretch without having another recession. We're due for one, and it's definitely coming. So be prepared. If you're interested in our newsletter, we focus on financial education. None of this is, actually financial advice or investment advice, but if you educate yourself, you can make wise investment decisions yourself, protect yourself, and even prosper in the next recession. Thanks, guys. If you have the time, I would really, really appreciate it if you come down here, subscribe, hit the like button, share the video with your friends. All right, I'll see you guys next week. Bye.